some of the more sophisticated estate planning techniques work really well with these low AFR rates. And what we're trying to do is prevent the size of the estate from growing. The client already has a large estate. They already have some estate taxes that they're going to pay when they die. But if they live their normal life expectancy, their estate might double. It may even quadruple, just depending on how old they are. In 7 years, the 7% is going to double. In 14 years, it's going to quadruple. Obviously, incurring much higher estate tax. And what we want to do with these techniques here is try and freeze the growth of the estate. So we might use a grantor retained annuity trust, where the parents set up the trust and they get the income, but the kids at the end of the term get the principal, or a charitable lead annuity trust, where the charity gets income for a period of time, and at the end of that period of time, the money goes to the kids. Or they might set up an intentionally defective grantor trust, which a lot of people refer to as an IDIT. And basically the idea there is we sell assets to this trust in exchange for a note, but the note is only at the lower applicable federal rate, which we'll show you on some slides. But in January when we did the slides, the midterm rate was 1.95%. And if those assets are generating 4 or 6%, basically the kids get to keep the spread, and that can work out to be a very effective way of freezing the growth of the parents' estate and getting a lot of money to the kids. Again, through what some people call private finance or a gift and loan arrangement, where the parents make maybe part gift, part loan to the kids, or the parents just make a gift to the kids where it's privately financing the loan to the kid. At the low interest rates, those can be very attractive, much better than what the kids could borrow money at from a bank or other financial institution. There's a tremendous opportunity to make huge lifetime gifts. You've got an ability, at least in the next 2 years, to make up to $5 million gifts per person. And one of the things we could do is put those gifts into these dynasty trusts, where it's not going to be subject to tax again for several generations. Also, if we've done something like a private split dollar arrangement, again, a fairly sophisticated insurance technique that we use with high net worth clients, we can use this ability to gift to roll out from the private split dollar arrangement. Or if they've made a loan to the kids to buy a house or start a business, we can forgive that loan and we can take advantage of that, and that would be an excellent estate planning strategy. As we said in the slide that at the beginning of this, the AFR rates are near historic lows. 75-20 rate that's used for some of these planning techniques, 2.4% back in January. Midterm rate 1.95, the long-term rate 3.88. If we were going to use one of those sales to a defective grantor trust strategy, typically what folks will tell you, what attorneys and or CPAs will tell you, is you have to have some quote-unquote seed money in that trust. So it's not all just the debt, that there's some equity in the trust as well. And so if the assets have declined in value, that's going to reduce how much seed money we have to put into the trust. And typically what folks tell you, the conventional wisdom is 10% seed money. So, if you put in $1 million note or sale of an asset, you'd want to have $100,000 in gift in a seed money. If we do the planning now, one of the things that we know as financial planners is time value of money is our friend. And the sooner you put the money away, the better it is, because we're going to remove all the appreciation from the estate. And if the assets now, like in real estate, have a depressed market value, we're going to get them out of the estate before there's a rebound in the market. And so again, making the gifts now in 2011 or 2012 makes very good estate planning sense. Just going to give you a quick example as we wind down over the last couple of slides of how the private finance would work. We have a business owner, and he wants to make a loan to his grantor trust. and he's going to make a loan of $1 million. And in this example, we're going to use a 10-year term, and we'll look at we'll talk about another alternative. And if we did that, the interest only with a balloon payment in year 10, he's going to get back the interest each year, and that's going to be based on the long-term AFR rate of 3.88%. So he's going to get $38,800 back each year for the next 10 years. And at the end of 10 years, he's going to get the $1 million back. But if the assets earn 6% over that period of time, and the grantor pays the income tax on that earning, so that 6% that's earned by the trust, neither the trust nor the kids, who are the ultimate beneficiary of the trust, are going to pay tax on those earnings. It's all going to get paid back by the grantor, which is in effect an additional gift from the grantor to the kids that doesn't count against his $13,000 a year. If the grantor dies in that 10-year term, or even at the end of the 10-year term, well, we've repaid the $1 million note, so that $1 million comes back into the estate, and all we've done is slow down the growth of his estate and transfer some money to the kids. And again, if he's got to put $1 million in there as a loan, we'd recommend to him that he put at least $100,000 of gift in there, seed money into this grantor trust. At the end of 10 years, even though we've been paying him $38,000 a year in interest payments over that 10-year period, the value of the trust has grown to $1,357,000, and that's just because of the spread between the 3.88% on the note, the interest rate on the note, and the 6% that we're earning. And at the end of 10 years, we're going to pay the parent back the $1 million, and the kids are going to be left with $357,000. So about 35% of the initial amount that we put in. And again, there's been a very low gift tax cost to do this, and we transferred a tremendous amount to the kids just because of the spread between the 3.88 and the 6% that we're earning on the assets. And because we've transferred that $357,000 to the kids instead of having it go back to the parents, that's helped freeze the value of the growth of their estate. Plus, remember, mom and dad were paying tax on all the income, that 6% income that's been generated by the trust. And so that's slowed down the growth of their estate as well. And the kids didn't have to pay any tax on the income tax on that $357,000 because mom and dad were paying it, so they get to enjoy all of it. So that's an after-tax figure to the kids. And one of the things that you might have noticed that when we went back here, I'm just going back a few slides, is the midterm rate was 1.95%. And if we did that, the top line on this slide would be about $1,650,000 at the end of only 9 years. Paying back $1 million would leave the kids with about $650,000. And so a lot of planners, a lot of attorneys and CPAs are recommending don't go for a long-term loan to the kids. Go for 9 years, somewhere between 3 and 9 years, so we can use that midterm rate and actually get more money to the kids in a shorter period of time. The last slide here is we all know that there's been a fair amount of deadlocking in Congress, and I think we're more amazed when they can compromise than when they can't, because gridlock has really been kind of where they've been at really for most of this year and for most of the previous 2 years. Certainly the estate tax has been one of the pieces in that chess game between the two parties, and it's been that way since 2001. They've never been able to compromise and get to and you see it here in blue, a permanent estate tax law. And right now, a lot of us are wondering if they're ever going to get there. What's going to happen at the end of 2012 or the beginning of 2013? Are we going to have another patch that goes for a couple of years, or we're going to finally do something that's permanent? None of us knows. Congress has fooled us so many times. I don't think most of us, want to make predictions about what Congress is going to do. But the new tax law doesn't provide a lot of comfort because it's only 2 years. And the thing that we want to remind our clients is the only law that counts is the estate tax law that's in effect when you die. That's the only one that counts. There's a lot of debt that needs to get addressed. The estate tax is one of the ways to do that. And what we've, basically what we've counseled most of our clients to do is let's not worry about what Congress could do. Let's assume that the news is not going to be good and do the most effective planning we can do based on that assumption, because in the long run, that's the best solution, is to not wait for Congress to act, but for us to act now, do the very best planning, assuming that whatever Congress does is not good news, because we can build enough flexibility into the plans that we can change them down the road if we have to or want to or need to. And the sooner we do our planning, the better time value of money and this 2-year window of opportunity. In this way, they can seize control of their estate planning and not wait for Congress to act. And that's pretty much what the new tax law is about and some of the opportunities in the new tax law. And if you'd like to turn it over for questions now, Stephen, we can take some questions.
Yeah, well, thank you, Bill. That was a great presentation. If anyone has any questions, go ahead and press *6 on your phone, and we'll open it up and if you have any questions.
I'm always glad to, when I'm perfectly clear. If anybody has a question, though, please feel free, invited to ask a question. Otherwise, I'd just like to thank everybody for calling in today.